Hello to everybody who's after joining us so far. You're all very welcome on today's webinar, which is going to be a guide to company shares and taxes. My own name is David Looney. I work as a financial planner with Alpha Wealth, and I'm delighted to be joined by Darragh McCormack today, who is a tax specialist. Obviously, when we're dealing with clients, we do come across a lot of clients that have shares through their employment, and I think a lot of them are, very confused as to how they work, what the tax implications are, as well as what to do with the shares in general. So look, hopefully there's going to be some really good takeaways for you guys over the next couple of minutes. If anybody's not too familiar with ourselves in Alpha Wealth, we basically run an independent financial planning company. So we deal with, a lot of things within that kind of personal finance space, savings and investments, retirement planning, financial planning. Um, and we do run quite a lot of these online webinars on various topics. We've ran over 120 various webinars since kind of COVID days, where we really started to get out there a bit more online on various different areas. So you can keep updated on what ones we'll be doing next on our website and our social media channels. But as I said, today is more focused on company shares and taxes. So somebody actually said to me yesterday that when it comes to investing in Ireland, it's more about knowing the tax landscape and the tax considerations and the tax obligations than it is about knowing about investments and invested markets. And I think there's a lot of truth in that. So I am delighted to be joined by Darragh here, who is a tax specialist, and he's going to make sure that I don't say anything stupid on the tax side of things. So thanks very much for joining, Darragh.
No problem. And good afternoon, everyone. I'm delighted to be here.
Yeah. Thanks, Darragh. So, Darragh, just to, I suppose, summarize what we're going to be covering today for anybody who's joined the webinar so far. Firstly, we're just going to be talking a little bit about the various different workplace share arrangements. So, the typical share purchase schemes where employees are buying the shares. We'll be looking at share options. We'll be looking at restricted share units or RSUs, where people are being essentially awarded shares. Then we're going to be looking at the various tax treatments of the shares, whether that's CGT or income tax, and, the various deadlines and what people have to be aware of and what they have to do. And just kind of going towards the end of it, we'll be focusing on managing risk and the importance of diversification, which I think is often overlooked. I think people have a tendency to just, not really view the shares that they're accumulating in their employer as an actual investment. They're just kind of there in the background, but it is actually important to take a lot of action on that, because you never want to be in a situation where you're too overexposed to one share. And of course, we will allow a bit of time at the end for a bit of a Q&A. So if anybody on the webinar has a question, look, feel free to pop them into the chat box or the Q&A box, and look, we'll allow a bit of time throughout the webinar or at the end. So firstly, just to kick things off, what is a share purchase scheme? So most people will be familiar with the normal arrangement where they can purchase shares in the company that they work for, usually publicly traded companies, your Apples, your Strikers, your, Google's, Alphabets, etc. And that's often purchased through a salary sacrifice or bonuses. Now, there's many different share saving schemes. You've your ESPPPs, APSSS, ESOTSs, and there can be a differentiation between revenue approved schemes or non-revenue approved schemes. But there is incentives for people to purchase these shares, because if I work in Apple, let's say, and I want to buy Apple shares, I could just go on to, an online exchange or deal with a stockbroker to buy Apple shares. So there needs to be an incentive for me to buy it through these, designated schemes, let's say. And one is that there is a tax saving, basically. So if you have a revenue approved scheme, you can purchase stock in the company that you work for up to a maximum of €12,700 per year. And many people I come across do that with a bonus. So how it would work basically is that if you're due a 10 grand bonus, normally you'd have to pay maybe 52% tax on that if you're getting it into your hand, but you can use the bonus to buy shares. So roughly maybe 10 grand bonus buys roughly 10 grand worth of shares, but there is USC and PRSI to be paid. Now, people do need to hold those shares for a minimum period of 3 years, the vesting period, to avoid the income tax. Then people can also get shares at a discounted rate versus the market value. So if a particular share is trading at, say, €100 per share today on the stock market, your company might give you the opportunity to buy it at €85 per share. However, that discount that you're getting can be subject to income tax, USC, and PRSI. And of course, there is tax on selling the shares as well. So there are capital gains tax is the tax rate that most people will be aware of. And, we know that it's 33%, but there's a bit more behind it. So do you want to just kind of take us through how capital gains tax works, how people can pay it, what are the pitfalls, what are the deadlines?
Absolutely. Yeah, so just following the slide there, so the CGT, it's 33%. And it's 33% of any profit made on a sale, which is the sale less the purchase cost and any kind of allowable expenses. So in the example there, it's there's a gain of 5,000, which is €10,000 worth of Apple stocks sold for 15,000. Um, so that gives you the gain of the 5,000. It's your chargeable gain, but your taxable gain is actually slightly less because you get a 1,270 annual exemption. That's every year. So that takes the gain down to 3,730, and that's your taxable gain, the amount you're actually taxed on. So it leaves you with approximately €1,200 of CGT. Um, that annual exemption, you only get one go of it. Right? So if you sell shares throughout the year, it's on the first ones that it comes off if the gain is higher. So the main thing to kind of watch out for in CGT is the payment deadlines because they're quite different to say normal income tax returns, which people might be far more familiar with. So it's based on when you sell. So if you sell between the 1st of January and 30th of November, you have to pay any CGT due by the 15th of December in the same year. So in this year, so 1st of January to 30th of November 2025, you'll have to pay by 15th of December 2025. If you then make a sale in the last month, in December 2025, your CGT is due by the 31st of January next year, which would be 31 January 2026 in the example. And this is where a lot of people fall down. The reporting is different to the payment. So you must report the CGT sale in your tax return um, by the 31st of October in the following year. So again, using our example, if we sell shares in 2025, any period in 2025, January to December, it goes on our tax return for 2025, which is due by the 31st of October 2026. So as it's it's a little more complicated than a normal tax return where your income earned in the period is is taxed in that year, and then your payment date is in October. So yeah, just to be very aware of the different payment and filing deadlines.
Perfect. And Dara, the Form 11 and Form CG1, what's the difference with those guys for anyone that doesn't know? Is
Ah,
one like the online format and one is the old paper form, or am I?
no. So the Form 11, that's your income tax return. So that deals with all your income and CGT in a year. So that's all sources of income from, say, salary, share dividends, rental income, all that kind of stuff goes on that form and it's calendar based. So it's January to December, where the CG1 is just specifically for capital gains that arise in that year.
Ah, perfect. And we talked about the annual exemption of €1,270, but there are various other, let's say, allowances that we can maybe offset against CGT. And the main one I think is previous capital losses, and that can be carried forward,
Correct. Yes.
forever, really. Is that correct?
Yes, absolutely. So any non-related losses can be carried forward indefinitely. Um, just as an aside, it's very important to get those onto your tax return so that you can track them year to year. Because in any period, there could be three or four sales. You might have a loss on two, and you might have a small loss coming forward, and then you might forget to add in next year's loss, or worse, not use it, at all, and end up paying more tax than you should have to.
Yeah, I think the overarching message here for everyone is that it is important to get a bit of advice because look, there's so many considerations that you have and deadlines, etc. So look, you never want to trip yourself up a bit. But look, we'll move on to the next share saving scheme that people might be familiar with, and that's essentially stock options. Now, stock options, it can be quite complex, but rather than buying shares today, they're essentially an opportunity to purchase shares at some fixed price in the future. And that option usually has an expiration date. So there is a need for kind of ongoing let's say, review of that options to see if it makes sense to exercise it. Now, usually you can either pay for the option with cash or maybe through salary sacrifice, or there might be, I suppose, a mechanism where you can also pay for it simply through a reduction in the amount of shares that you actually receive when you do exercise the option. So, for instance, let's just say that we have an option to buy €100 shares at €1 per share in 5 years' time. It does require a bit of review, and basically, if the actual share price goes up, it would make sense to exercise that option because it translates to a guaranteed gain. So, let's say in this particular case, if the share price went up to €1.30 in 5 years' time, sure, we'd be crazy not to exercise that because we can get a guaranteed 30% gain. However, if the share price has fallen below €1, we're into a loss-making scenario, so it wouldn't make sense to exercise that gain. Now, there are stock options can be quite complex as well from a tax perspective because it's not just kind of CGT involved. And you spoke to me previously about the various life stages of share options. Do you want to just kind of explain that and then the, let's say, considerations and obligations and deadlines again when it comes to that?
Absolutely, yes. So in the tax life of a share option kind of has three main stages. So the grant is that's when the grant is given for you to acquire the shares. There's no tax liability when that happens. I suppose the key one then is the exercise of the share option, and this is triggered uh, in two scenarios, and the two scenarios are date based. So we have prior to January 2024 and after January 2024. So So any share options, we'll start with the nastier one first, the prior to January 2024 one. So any share options exercised before then, the tax is paid through a system called the RTSO. Um, and the key part here is that employees are responsible for paying this tax. So it's income tax, USC, and PRSI within 30 days of exercising the option. Employers do not deduct tax through their payroll. Um, So that's the first part of that. So the emphasis is on the employee here when the share option is exercised. The second part of it is that when you exercise that share option, you're made a chargeable person. And you might say, what's a chargeable person? Well, that means that you have to register for income tax and file a Form 11 by the normal deadline, 31st of October following year. Um, so that's quite um, onerous on the employee. So they have to remember two things. They have to remember to pay the tax, and then they have to remember to register for income tax, if not already. And then they have to, third thing, remember to put it on their return. In fairness to revenue, after January the 1st, 2024, it did become a little easier. And this is what I'll just focus on now. So again, if you exercise your share options on or before 1st January, the income tax, and when I say income tax, I mean POE, PRSI, and USC, that's all
Mhm.
taken care of by your employer through your payroll. Um, so that's fantastic. So it takes all that reporting and payment option off you. Then the second part, which is also good news, is you're not classified as a chargeable person. So therefore, you don't have to register for a Form 11. You can register through My Account, which is a far simpler process altogether. Um, so that's kind
That's
of what
a
happens
very
to the
welcome
shares.
change there, Dara.
Oh, very, very. It's very difficult because these transactions could happen over a number of years, and people think they're doing the right thing, you know. Then so that's when the exercise is done. Then once you actually have the shares and own them, the last stage of life is when you sell them. So and then this is where the CGT kicks in, and this is where people can get confused between income tax and CGT. So the other two events have happened first, and then when you sell them, you trigger the CGT life event. And again, as we discussed just a couple of slides ago, it's 33% on the profit, or as we call it, the gain, which is the the allowable amount after any expenses over your purchase price.
While we're on the topic of CGT, Dara, we just have two questions that came in relation to it. One is that if I make a profit on one share, sell it, and reinvest in another stock in the same year, does tax still need to be paid and like a return still need to be filed? And my understanding of that is yes. And
Yeah.
look, you might confirm
Yes,
that.
yeah. Yeah, that's correct. Yeah, that's so there are some scenarios where disposal of assets and stuff can be reinvested, and the CGT would not apply for shares and certain types of shares. I suppose I probably need a little bit more information, and we can we can somebody can reach out afterwards. There's no problem there. But generally, boys, yeah, when you sell that transaction, reinvest it, the life stage is over. So you do your CGT and you move on. And the same again starts then when you sell the new one. But again, there are some scenarios where CGT may be um, relieved through reinvestment. But again, depends on the type of asset, and there's a few conditions to it.
Yeah, I see that quite common. It's something that trips a lot of people up because I find nowadays people are mad to go investing online and going down the DIY approach, and a lot of people end up selling shares or crypto or some
Yeah,
kind of asset through a various online platform at a gain to buy another one, not realizing that it is a taxable event just because it's within the one brokerage account or the one online platform, you can't just
exactly.
simply move money between one asset to the other. So it can trip up a lot of people. And I said to somebody earlier that I'd say, Jesus, like a massive percentage of people that invest online are probably opening themselves up to a bit of a revenue fine if they really looked under the bonnet or got
Oh,
audited. Yeah,
absolutely,
yeah,
absolutely. And the way you'll kind of see it is you'll see on the, say if you use a brokerage, you'll see a listing of your sales in the year. So it's incredibly easy to find it. And sometimes they'll even give you their version of the gain, which would, be a very basic one, to be sales, proceeds, less cost. But it's a starting point and it's straightforward. You can see them and you can calculate the gains in no time at all, really.
perfect. I'm just conscious of time, so we'll try moving on. But just one very more quick question in relation to CGT. Somebody is asking, how can you register past losses with
Oh,
revenue?
yes. Yeah. So what you can do is in the current year, so if you haven't filed your 2024 return, just put them onto that one. Um,
Perfect.
and then revenue, as far as I know, it'll be pre-populated coming forward then.
So
So
there's a section on the Form 11, is it, to include
absolutely.
losses as
Yeah,
well?
there's a section. If you come down, it's about three-quarters of the way down through it. You'll actually see it. It's losses brought forward, and you just pop it in there in the first year. Always good to keep a physical backup, Excel spreadsheet
Yeah.
of them as well, for backup of that loss figure in case revenue ever question it.
Perfect, perfect. So we'll move on now to restricted share units or RSUs as they're known as. Again, a bit more complex than, just buying shares, and they're basically just actually being awarded shares in the company, aren't they, rather than you buying it. We're finding that they're maybe usually used to attract and retain key employees. So maybe somebody is enticed to come work for a particular company by getting a number of RSUs vesting over the initial years in their contract. So for instance, you might get 100 RSUs vesting over the 3 year period, with a third of those vesting each year over 3 years to kind of try to harbour some commitment to the company over the first couple of years. And kind of like the options, Dara, there is income tax, USC and PRSI actually on the value of the shares, because I mean, like if your company gives you 100 grand worth of shares, that's not all just going to be tax free. There is going to be some tax to be paid, and then you've your CGT as well, isn't it?
Exactly. They're quite similar in taxation life as the prior ones. Slight differences as the restriction is the key word there. You're restricted on them for a period of time.
Perfect. So we already alluded to, how easy people can be tripped up when it comes to their tax obligations and the various deadlines. And you stressed a couple of other points, some kind of tax challenges to look out for. Do you want to just kind of run through those?
Absolutely, yeah. These are kind of some of the main pitfalls that we see in the firm here. Um, so obviously, point one relates to any events prior to the 1st of January 2024. So that means that you've exercised the share option and haven't filed or paid the relevant option tax on it within 30 days. So that's for anybody who's had, like I said, the key date there is, remember, 1st of January 2024 backwards. Very common one. And as we'll see further, revenue are very keen on this. So point two, this one is also very common. Um, People would, and I see it a lot, failing to pay the CGT when the shares are sold on the right dates because they think, oh, it goes on my income tax return, I'll just pay it then, which is incorrect. So, as I said, it's 15th of December and 15th of January are the key dates you want to remember when you're selling. So, sale between Jan and November, 15th of December, sale in December, 15th of January the following year. Um, and then this one again, these are, like I said, very, very common. And people might be worried that this is a very, very common, purely admin error number three. They don't put the CGT information on the return. Um, if you do a Form 11 and you do it yourself, it can be quite complicated. And there's a section for CGT, and you could very easily miss it. It's just down the side if you're coming along, oh, I've paid my tax, all is good. Um, Point three is the one that would generate an issue from revenue if you've made a payment and not put the information on your return. It would trigger for them, well, why have you made a payment? If you haven't sold anything, it's a very easy question for them to ask. And it's normal, there's a very innocent answer. I just forgot or didn't know. But again, once you're dealing with them, the stressing that can bring is
Yeah.
is large. So then, yeah, so this is just moving down slightly lower down the slide there to where it says revenue. So they're actually carrying out a compliance campaign for 2023 tax year on the share option schemes because they had a very successful campaign in 2022 tax year where they got 8 million in unpaid taxes through share options. So logic dictates that if they got 8 million in 2022, they're absolutely going to shake the tree as hard as they can in 2023 because obviously from 2024 your employer will be taking care of all that tax for you. Um, the advice, and I said I've had a few cases with these, is to just engage with them as early as you can. Um, there's no point in trying not to or putting your head in the sand, because your employer will already have given the information to revenue. Um, so they have already, would you believe it, issued letters to 1,000 people that have not replied. So how many letters they issue? There's 1,000 people out there who just haven't replied to them. Um, and the latest word from speaking to revenue is that they are shortly going to escalate these cases. Um,
So
so
that's kind of like shooting fish in a barrel. So with this new change to the RTSO, where it's up to the I suppose the obligation is on the employer to kind of report to revenue who's getting options, who's getting RSUs. So revenue already have a record of who has shares linked to your let's say PPS number.
yeah,
So if there's not a let's say a following CGT return or something like that in relation to the shares, it's very very easy now to go
very
after
easy.
these people, isn't it?
Oh, very, very easy. And I said it really is you've described it perfectly there, shooting fish in a barrel. They know the money is out there,
Yeah.
waiting to be paid.
And what
Um,
would you say to somebody, because I have come across these people before where they've been accruing shares in the company, selling them, cashing them in, never done any CGT returns, but they're now looking to get a bit on side with revenue. Would they be just wipe the slate clean and do it from this year and try to make sure every year going forward is done by the letter of the law?
no.
Or should they be trying to, go back to the previous years and tidy
Oh
things
yeah.
up? Or,
Yeah, absolutely. So there are some options to self-correct. So you try to avail of those as quick as you can, with up to prior years. Um, so that's very, very important. I think if you get a letter from revenue, so they're normally what they've sent out in these cases are what they call level one compliance letters. Um, there is, they do allow for corrections on those letters. So if you get one, don't ignore it. Absolutely, go back to the years, get it in order, and submit them all. And generally, revenue would be happy with that, as long as the sums aren't gigantic or they feel that there's no fraudulent trading or something like that. That's how I'd absolutely deal with those. If they move to level two, you're far more restricted in what you can do. So at the minute, all those 1,000 letters that would know they're still level ones. So if you've got one, but now is the time to act, definitely, and
that's
get 3 or 4 years, as many as they are, just get them in order, get them done.
Yeah, good advice there. So for anyone listening, make sure to get on site as soon as possible. Something really interesting, and we were talking about it over the last couple of days, and something that trips up a lot of people, or something that's not really known about, is like a lot of, let's say, Irish-based employees. They're working for US companies and acquiring shares. Let's say Apple could be an example, which is a US-based share. And that can come with certain, pitfalls when it comes to things like, inheritances and passing the share values on to spouses on debt.
Absolutely, yeah. So, um, if you view a shares and they're over the value of $60,000, there's an estate tax in the USA, which can be up to 40%. It's a sliding scale on the way up. Um, so even if you are living in Ireland, and been here all your life, it's something to be very wary about. This does apply, and it can mean that if you couple it with other taxes, it can go really high. And in some cases, it can go right the way up to 73, as you said. There are some possible exemptions with double taxation, but very tricky, and needs a lot of specialist advice and planning around that because there are lots of conditions attached um, to see if it could be applied. Um, yeah, so
Yeah,
look,
and that's
Irish-based investments don't suffer from this, which is, they obviously because they're not captured in America. Um,
yeah, because in Ireland you have like unlimited tax-free thresholds between transfer of assets, even before debt or beyond debt, let's
yeah,
say. So I do come across a lot of people that most of their wealth and future financial security is actually tied to the shares that they have in their workplace. So like that can come with massive, risks down the line where not knowing, unknown to them
absolutely.
now,
Yeah,
their spouse could be
because
hit with
yeah,
a massive tax bill on receiving that. Yeah.
absolutely, as you said, normally, and everyone, probably everyone you speak to in Ireland would know that there's, between husband and wife or partner, civil partners, it's tax free. Anything you give them, there's no CGT involved at all. And this is, as you said, it's a very unusual um, quirk that could catch people. Um, so as I said, you have some solutions there, yeah, in which to avoid it.
Yeah, we'd be leading on to that in a second, but obviously, yeah, the solution is to sell and diversify into assets which are not based in the US, and people have a lot of options there. Just going to the questions very, very briefly. One for you. Are dividends from shares held subject to CGT or taxed as income? That's first.
Dividends. Yeah, dividends are taxed as income. Um, it's uh, the gross income is put onto your income tax return. Any withholding tax you do get a credit for. So again, depending on your personal circumstances, there may or may not be additional liability there on those. Um,
So obviously, there's requirement to include that in an annual income tax return. And I see that's something that
yeah,
trips up a lot of people that try to go down the DIY investing approach as well, because they're buying shares or buying ETFs through an online platform, which is actually distributing a dividend into their online stockbroking
sure.
account. And, generally people are not doing an income tax return declaring that, whereas they should be.
Absolutely. Yeah. There's the shares carry a couple of tax issues. I know we're dealing mainly with the CGT and the options and that, but yeah, there are income tax implications and dividends, as you quite rightly pointed out. And sometimes people don't know it's a dividend, but still should be returning it on their income tax. And there could be all sorts of issues with that, including foreign taxes and stuff
Perfect.
related to
So
them.
thanks for that, Dara. Just going beyond that, okay, beyond the tax side of things, and we will bring Dara back into things in a while. I just want to focus over the next couple of slides on what to do with let's say accessible or vested company shares, because it's a question I get asked quite a lot. Our advice is always, and it won't change, is to keep acquiring them. I mean, it's a fantastic benefit to have, but always sell them and diversify. Why? Because firstly, as Dara alluded to, you do benefit from a €1,270 tax-free gain, and it can't be backdated, as Dara said. So it's a use it or lose it. So by selling some shares every year, you're guaranteeing that you're getting €1,270 tax-free. But probably more importantly is to avoid overexposure, because we never want a scenario where your financial security is overexposed to the success or the share price of a particular company. As the old adage goes, don't have all your eggs in the one basket. And so there's many issues with holding individual company shares, and don't think people pay enough attention to this. And as I say to people, your shares might have done quite well, but there's always shares which do better. And respectfully, whether you work for Apple or Google or Stryker, no one on this planet can tell you that it's a good idea to keep holding your shares in that specific company. And some people say to me, "Oh, I'm an Apple share. Their share price has skyrocketed over the last couple of years. It's gone up, 247%." And I say, respectfully, there's companies like Nvidia that have gone up 7 times more than that. So you can't say that it's a good idea to hold money in the company you work for just because it's going up in value. And so I suppose what I would say to people is that it does make sense to move it into a diversified portfolio where it's made up of hundreds of shares and hundreds of other assets, because it's the only way where you can ensure that you always just get exposure to the best performing companies, but also avoid losing significantly on the worst performing companies. And I think that's more important now than ever, due to the volatility we're experiencing with our buddy over in the US and his kind of policies, and how it's impacting the markets over the last 2 weeks. And what I say to people as well is that it is important to remove your bias and forget the fact that you work for that company. and look at the shares solely as an investment decision. So, for instance, if you came into me with €50,000 to invest and I told you to put it all into Apple shares, you'd walk out the door and never talk to me again. Whereas people are happy to hold 50,000, 100,000, 200,000 of Apple shares just because they work there. It really doesn't make sense. There's no investment rationale behind it other than the fact that they work there. I think this is a really interesting slide. Most people might be familiar with the S&P 500. It's an index tracking the stock price of the top 500 companies in America. It's seen as being a good proxy as to how the stock market is performing, but it basically just shows the top 10 companies in the index over the last few decades. So if we go back to the 1990s, we have a lot of kind of, let's say, energy stocks in there. But I suppose, and now obviously in the last couple of decades, it's the kind of the tech companies. But what you'll notice is there's rarely a case where a company stays within the top 10 over a couple of decades. Like, let's just take Merck for an example. They were in the top 10 in the 90s, in the top 10 into the 2000s, and now they're way out of it and they're way down the pecking order. So a lot of these people that are heavily exposed to the tech companies like your Apples and Googles, you could argue that maybe down the line they'll start dropping out of it eventually. And I suppose the only way that you can ensure that you're always getting exposure to the best stocks is to actually own a large portion of the market. And that's a lot easier than it sounds. It's simply just you selling your shares and then reinvesting that money into a diversified fund or an ETF. And like individual company shares can actually be extremely volatile, even blue chip companies. And we're seeing that at the moment. If you go back to 2022, which was one of the worst years we've seen in stock markets since 2008, the S&P 500 fell 20%. Whereas Amazon fell 50%. It lost 50% of its shareholding in that year, despite the market overall only falling 20%. And you can even get better returns at much lower levels of risk. So, for instance, what I've done here is just compare Pfizer, which a lot of people I know in Cork might have a shareholding in, to maybe a company like Coca-Cola, to the NASDAQ 100, which is actually made up of 100 companies, mainly tech. So basically, Pfizer, one stock portfolio, very concentrated, very high risk, has lost 17% over the last 5 years. One stock portfolio, Coca-Cola, has only made 32% over the last 5 years versus a 100 stock portfolio like the NASDAQ, which is up about 143% over the last 5 years. So there's loads of hundreds and hundreds of company shares out there that are consistently losing value or actually underperforming the market, despite those companies being household names or seemingly being very, very strong companies. And of course, we have the Trump effect. Many stock prices have taken a big dip in the last couple of weeks, but others have actually done quite well. So we talk about the importance of diversification now more than ever, not just within equities, because today is very much about talking about shares, but it's also important to diversify into other asset classes like, alternatives bonds, because by adding more assets within your portfolio, you're helping to dilute the volatility that's coming with stock prices. So this is an article from RTE just yesterday. So basically it's alluding to the fact that gold prices have reached record levels over the last couple of years. Gold is an asset class. It's usually seen as a safe haven when stock markets are going through uncertain periods. Then you had a company called Palantir Technologies, which is actually like the best performing stock of 2024. Their share price like went up massively last year, and just due over the last month, let's say, you can see it's after losing nearly a third of its share price. Whereas in the same period, the old reliable Berkshire Hathaway, Warren Buffett's company, has actually gone up 5.5%. So again, having a diversified portfolio is the only way you can kind of capture the uplift in some companies whilst not being too overexposed to declines in certain assets in other companies. And so where do we allocate liquidated shares? And what I want to really stress today, and I want everybody to really be conscious of this, where you have your money really boils down to the time frame that you have in mind. So anything coming up in the short term, let's say, and I would determine the short term as being, say, today to maybe a 4 year period. So, going on holidays, changing the car, maybe having a bit of a house deposit, that really does need to stay in savings accounts, so not invested. So, I meet people regularly that they're using their shares or they're using their investment portfolio as a way to release cash to them for short term let's say expenses or needs, which really isn't appropriate because markets can be really volatile in the short term, and you do need to give investments time to work really 5 years beyond. So once we do have that longer time frame, I believe people should be investing their shares or their money in diversified portfolios and funds. Now, firstly, just on the short term space, we've gone through a really interesting period in interest rates because they were 0% for the best part of about, was it 14 years or something? Then they shot up and now they're starting to reduce. But there are still really good rates out there. And we're finding that the best rates for short term savings are actually offered through some of these various online banks, the likes of Trade Republic and Raisin, for instance. Now, people are familiar with Revolut, which is the online bank that most of us use, but sometimes it's important to look under the bonnet, okay? Trade Republic and Raisin currently are offering rates of about 2.7%. Now, this actually has reduced a little bit in light of the last ECB cut. They're secured by fairly strong banks. They're covered under deposit guarantee schemes, and they're subject to dirt tax, which is 33%. However, a lot of the accounts that Revolut advertise actually involve either holding money in different currencies where you're taking on unnecessary exchange rate risk, or they're held in funds, money market funds, as opposed to deposits, which are dirt, obviously. So they're taxed at a higher rate of 41% versus 33%, and they may not be covered under government deposit guarantee schemes. So, if the bank were to default, let's say, there's nothing securing the deposit. So some people ask me how safe are some of these online banks, like the ones that I've, alluded to, like Trade Republic and Raisin, and they're surprised when I say to them that they're actually in a lot of cases much safer than the Irish banks, because you'll see that there's a series of three letters after some of these Swedish banks that are available through Raisin. That's a AAA credit rated bank, which is a higher credit rating than most Irish banks, which are a B credit rating. They're giving pretty decent returns, and they are covered under the deposit guarantee scheme. Now, whilst I have Darragh, it is important to note that Darragh, I think with a lot of these banks, they do pay the interest gross, which is different to the traditional Irish banks, which deducted at source. So I'm correct in saying that people do need to include any interest that they're getting from the Revoluts and the Trade Republics of the world in their tax return, Darren, or how do they go about that?
Absolutely, yeah. And similar to the capital gains that we spoke on previously, there's a section for interest and investment income, um, and that's where it's recorded. So if you do the Irish one, you put in the gross, and you get a credit for the dirt that's been stopped on you automatically. So that comes through. That's worked out for you on the form, which is very handy. Um, and if you have one, say that's paid gross, then yeah, the responsibility is up for you to put it on your return and to pay the dirt tax on it. Um, as an aside, that revenue are aware of say larger interest payments, over 500 in a year. So they would be a very simple question to be asked is why isn't it on your tax return? And you say, oh, I pay dirt on it. I don't have to, but you still have to pop it on there, onto the return. Like I said, if it's one that dirt is stopped on, you won't have to pay any tax because the dirt is given as a credit against it, but it still has to go on the return. So
Okay.
for the ones like that pay the gross, they go on the return absolutely, and then you have to pay the tax then at the 31st of October or whenever you file your tax return.
Perfect. So just to be conscious of that for anyone that is pursuing these opportunities, but I think it's definitely worthwhile because they do traditionally pay much better interest rates than the Irish banks. You have to be careful as well because some of the online banks or the banks in different jurisdictions, they do take a withholding tax there. I normally
Yes.
do encourage people to look at the options that have no withholding tax, like the ones on screen here through Raisin. But I think like banks in Latvia, for instance, they might deduct a withholding tax, and you then need to submit forms to the revenue authorities there,
Uh-huh.
Dara, to make sure that you're not being double taxed.
Correct.
Is
Yeah,
that correct? How
that's
do you go
correct. Yeah.
about that? Have you come across that?
Um, yeah, that's a it's a difficult one. Yeah, because you kind of have to reach out to the foreign banks. You can, on occasion, if you're registered for a Form 11, you can actually put in the withholding tax once you have proof that it's been stopped on you. So you can include it to get it back that way. Um, but yeah, of course, it is better not to have it stopped at all. If you can get it not
Yeah,
deducted at source, it's much handier because it's another thing you have to remember to put on your tax return. And
exactly.
very easy as I've spoken about earlier, very easy just to miss something like that and do yourself
Perfect.
out of funds.
Yeah, and while we're on the topic of convenience and longer term investing, I just want to talk about the various investment funds that people can access very very easy. In Alpha Wealth, we act as an independent broker of investment funds, so we regularly give our clients advice and arrange solutions in some of the best performing funds in the Irish market. Now these can be invested on a monthly basis or as a lump sum. It's allowing people to get access to a really diversified portfolio at very low entry levels. So it's great for anything from trying to diversify your shares to saving money for your kids' education or any other future needs. And the returns can be quite good. And again, I do stress to people that to have this concept of risk versus reward, and the risk level that you take is very much based on the time frame that you have ahead of you. So short-term stuff has to stay in, cash deposits. Medium to longer term stuff can get invested, but how much exposure you take to say equity markets or stocks and shares or high risk assets should be based on the time frame that's ahead of you. So for most of us, let's say maybe our pensions should be our highest risk investment because they're the longest investment that we will typically hold. Um, just to give you an example of some options that are on the table, and we work quite a lot with Zurich. I would see them as the best investment manager in the Irish market. And one fund that I regularly talk to people about that want to look at ways to diversify their stocks, but still benefit from the growth in stock markets is global equity funds. So Zurich have a brilliant global equity fund. It's made up of over 500 stocks from the biggest companies across the world. It is provided by Zurich, who've been successfully managing funds in Ireland now for about 40 years. So they're the largest insurance and investment manager in Ireland, but one of the largest worldwide as well. Now, why I like life companies funds like Zurich is that there's zero tax obligations for you. They're just completely hands off because any of the dividends are reinvested in the fund, and when you take money out of the fund or when you cash the fund in, the exit tax is actually deducted at source, so you don't have to go to someone like Darragh to assist with doing your returns, let's say, or you don't have to be worried about getting tripped up with any kind of deadlines or what the obligations are. And this fund also has produced stellar returns, like it's averaged about 14% per year over the last 5 years or 12% per year since the fund was launched. It does have an annual management charge of about 1% per year, and some people might say, Jesus, that 1% per year, so that's a bit more expensive than me buying shares or, getting access to an ETF. Yes, but buying ETFs and shares can be risky. And as we already alluded to, it can come with a lot of, headaches and considerations and the risk of getting, tripped up with revenue fines. Whereas with the life company funds, they're completely hands off, which is why I like them for people, so people can get the growth from markets in a very diversified and hands off way. But as I mentioned earlier, we don't have to always be invested in shares either. And history has shown that once we start adding more assets into our portfolio, like alternatives, like bonds, it does help to dampen the volatility that we're seeing in stock markets. And that's very important at the moment. So another option would be Zurich's Prisma 5 fund, which isn't just in shares. It only has about 74% in shares, and it also has some access. Sorry, it has some exposure to alternatives, bonds, and property. So still a really well diversified fund, about 450 assets within it, equities, bonds, cash, and alternatives, and that fund has delivered returns of about 10% per year. So just what I want to kind of hammer home to people here is that it is very easy to get good returns, maybe better returns than you're currently getting from your own company shares at much lower levels of risk and maybe in a much more convenient way. So look, just to say to thank you for everybody who's taken the time to come on, and we will maybe move on to a bit of a Q&A session now. There is many questions in the chat box, so so I'll just try to work my way through them. Darragh, I have a lot of questions in, not to put you on the spot, but people are asking, what's involved to engage with somebody like yourself, or what your fees are maybe for just doing kind of a simple CGT return, or how can they best kind of get in touch with yourself?
Oh yeah, yeah. So I think we'll have my email address at the end of the presentation for anyone who wants to. That's no problem. They can reach out to me or reach out to
Yeah.
yourself, and you can uh, pass on my details. Normally for these kind of transactions, they're not overly difficult. They're straightforward enough once you get into the swing of them. So like how to say, how do you charge for that? I always think like is complexity and time is how I kind of base my fees. So for those if anyone was looking for say an income tax return with a capital gains tax, you would say between 350 to 650, depending on the complexity involved. Hope that helps anyone. Oh, sorry, and that's a net of VAT. Because sorry, I know people. I always hate it when people quote without the VAT. So just let people aware.
Perfect. Thanks, Dara. Good question here. Somebody's asking if the gain is below €1,270, do we need to report it or not, basically, because it's below the annual exemption?
Exemption. So there's no payment due, so you don't have to do anything there. But yes, you still should put it on your tax return. So you put in your proceeds, you put in your gain, and then you take off your 1,270, and that leaves you with zero, if you like, liability. But yeah, it still should go on your return. Again, more a
Perfect.
compliance issue than a payment issue.
Yeah. So somebody's saying that they have company shares in Dell. They've never ever sold them. Hopefully, look, you've taken something from the last couple of slides there. They've never had any dividends, and whatever taxes due is deducted yearly from the account. Do they have to do anything else with regards to tax?
No, not if they haven't sold them or they haven't received dividends. So they've gained no income from them. Um, as far as I know, like I said, if there's maybe a growth in the overall portfolio, there may be some issues, but like at a very high level, no CGT obviously as no disposal, and no income tax as no dividends or income received.
Perfect. Thanks, Sarah. Just on the investment side of things, somebody's kind of alluding to the fact that a lot of shares have moved over onto US listings, and they're talking about the non-resident estate tax over 60K hidden people. Can they simply move those shares onto like a non US based exchange? And yes, I believe so. Like if you're investing online, you can invest in assets that are not domiciled in the US. So it could be domiciled, let's say, in the EU or domiciled in Ireland. So again, it's just about kind of, selling your shares if you were exposed to that and diversifying into Irish based or maybe EU domiciled investment assets, which don't have, can't have the tendency to trip you up on things like that. Um, is CGT considered on a FIFO basis, so that's first in, first out, or can I specify which vesting of shares I am selling? Do you know that there?
No, so yeah, good question, that one. Yeah. So generally, by and large, it's first in, first out. That's the rule, unless you are buying and selling within 4 weeks. Then it's that share that you're selling. So if you get one and sell it straight away, it's that one. But by and large, for most of these transactions, as they vest, and people sell them at a later date, yeah, it's the first in, first out method.
Perfect. Thanks, Dara. And so maybe one for myself. Does dirt represent 100% of the tax liability on interest, or is there a further liability for 40% for the taxpayer? Or maybe for you there or both of us, but no, it's just the dirt tax, and dirt tax is actually only 33% on deposit interest. There's no further tax on that, correct?
That's correct. Yeah, it has a relevant tax. It's very different to, say, income tax and capital gains tax. It has its own relevant tax. So you're absolutely correct there, David. Yeah, no additional liability to the taxpayer.
Yeah, so it's important that people know the different kind of tax regimes. So like obviously there's income tax, tax on your income and dividends, etc. CGT is on the disposal of certain assets like, property, shares, crypto, etc. You've exit tax, which is based on funds and ETFs and stuff. Then you have dirt, which is specifically for deposit. So it's just about knowing, what the tax treatment is of the particular asset that you're in. And of course, pensions, which we probably didn't talk about, are a great way to reduce tax on all of those because there is no tax on the interest. Somebody asked the question in light of that, that if you sold shares and moved the money into a pension, could you basically not have to pay CGT? And the answer to that is no. You would still have to pay CGT, I believe, and Darren might correct me there, but you can then, get some of the money back due to the tax rebate that you're going to get by making the pension contribution. So for instance, if you say sold shares, paid your CGT, then put say 10 grand into your pension as an AVC, you'd be liable for, or you'd be, eligible for a 40% tax rebate as a top rate taxpayer. So that would be 4 grand coming back to your bank account for a 10 grand AVC into your pension, which would help to maybe reduce your overall tax liability on the CGT that you had to pay.
Exactly. Yeah,
Um,
two separate taxes is the way to think of that. Is what you have there. You have the income tax saving versus the CGT liability.
Perfect. So I don't think there's any more there. So as I said, look, just massive thank you to everybody who's after taking the time to come on. Massive thanks to Darragh. Look, some really, really good advice there. And look, I think the overarching message there is to get some specific advice from somebody like yourself if they are I suppose if they're affected by any of the things that we spoke about today, just to make sure that they're not leaving themselves open to, revenue fines or audits or anything like that. Perfect.
Absolutely.
So look, thanks a million, Dara, again, and
Yeah.
have a great day, everyone, and
Well,
enjoy
yeah,
the
thanks so
long
much for having me
weekend.
on.
No worries, Dara. Bye now.